Let's get more on this now with Tim Waterer in Sydney. He's Chief Market Analyst at KCM Trade. Good to have you back on the programme with us, Tim. Now, chipmakers and AI-linked stocks delivered huge gains this year. Are these rallies still backed by fundamentals, or are valuations now just running ahead of earnings?
Nice to be with you again. Good morning. My take is that earnings right now, I would put them in a category as being elevated rather than extreme, but I would also add a caveat there. It depends on where you look within the AI space. Now, I think for the core AI chip makers, such as NVIDIA or Broadcom, I'd say the current valuations are justified based on recent earnings. And also for the hyperscalers, such as your Googles, Metas, and Microsofts, I'd also say that their forward guidance does support the current valuations. But I think there is more of a question mark when it comes to some of the second-tier companies within the AI space or AI-adjacent stocks where monetization remains a big question mark. And I think that's where you could find examples where valuations are outstripping earnings at the moment.
Now, banks and gold both did very well this year, even as central banks started cutting rates. What does that tell us about how investors are positioning for growth, inflation, and geopolitical risk?
A lot of the economic risks that were present in the first half of the year, they did dissipate to a large extent, which helped credit demand, and that helped the banking stocks. Also think that the lenders, their net interest margins, they held up better than expected at the start of the year, and I think that saw some repricing and value added back onto the price of banking stocks. And as for gold, yeah, I mean, that's really risen to the task again this year and is ticking the box for a lot of investors as being an asset for all occasions. So we know that central bank demand remains very strong, but I think investors like to have gold in their portfolios in case things do turn pear-shaped and we do get bouts of risk aversion. Gold tends to do well there. While with US interest rates projected to move lower next year, that helps gold from a yield advantage as well.
Looking ahead into 2026, where do you see the biggest risks for markets, and are there any overlooked sectors that could move from loser to winner?
Number one, I would say risk remains tariffs. We could see Trump a little bit less cavalier in 2026 with US midterm elections due later that year. So we may not get quite the turbulence that we saw during 2025, but with the current truce with China due to expire next year, we don't know what will happen next on that front. So US-China trade relations, that remains a risk, I think, moving forward. I think we've seen in recent weeks a bit of a rotation out of AI and tech stocks to the broader economy. I think that is healthy because if the economy remains too reliant on tech, then I think that's a risk into next year. Looking at sectors, I think utilities, that could be one to watch, particularly if the AI demand remains robust, because that means that there'll be a lot of demand for power generations, and that's where the utilities sector could come to the fore and perhaps shake off its mantle as being something of a safe haven sector and one which is more perhaps linked with AI demand moving forward.
All right, we will have to wait and see where 2026 takes us. Tim Waterer in Sydney, thank you very much as always.